Imagine someone handed you $100,000 today. Would you invest every single dollar immediately? Or would you slowly invest it over the next year? One decision could leave you with thousands, even tens of thousands, more in retirement. The other might help you sleep much better at night. So which one is actually smarter? For decades, investors have argued over two strategies: lump sum investing versus dollar-cost averaging, or DCA. Today, we're looking beyond opinions. We'll examine decades of market data, one of the largest studies ever conducted, and a surprising 20-year experiment that shows what happened to 5 very different investors. The results might completely change how you invest. Let's start with the basics. Dollar-cost averaging is incredibly simple. Instead of trying to guess when the market is at its lowest, you invest a fixed amount of money on a regular schedule, like $500 on the first day of every single month, no matter what. When the market is booming and prices are high, your $500 buys fewer shares. But when the market panics and crashes, your $500 snap up more shares on a discount. Think of it like shopping during sales. Nobody complains when their favorite shoes go on sale. But somehow, when stocks go on sale, people panic. DCA removes one of investing's biggest enemies, trying to predict the perfect time to buy. Over time, this naturally averages out your total cost per share. It takes the guesswork out of the equation. You aren't timing the market, you're just logging hours in it. Now enter the opponent: lump sum investing. This is the one-and-done move. You take all your cash and throw it right into the market on day one. Mathematically, a massive study by Vanguard checked out historical data over decades and found that lump sum investing actually beats DCA about 2/3 of the time. Why? Because historically, the stock market goes up far more often than it goes down. By holding cash on the sidelines to trickle it in later, you miss out on early growth and inflation slowly nibbles away at your spending power. So from a purely statistical perspective, getting your money invested as early as possible usually produces higher returns. But wait, numbers on a spreadsheet don't account for human emotion. Let's look at a fascinating 20-year study by Charles Schwab that tracked 5 completely different types of investors from 2005 to 2024. Each got $2,000 a year to invest. Each follows a completely different strategy. Let's see how they finish. First was Peter Perfect. He used magic to time the absolute lowest point of the market every single year. After 20 years, he walked away with over $186,000. Second was Ashley Action. She didn't think at all. She just dumped her full $2,000 in on day one of every year. Her result? $170,000. She only lost to perfect market timing by about 16 grand with zero stress. Third was Matthew Monthly, our DCA hero who split his money into 12 monthly payments. He finished incredibly close at $166,000. Even Rosie Rotten, who accidentally invested at the exact peak high point of every single year, finished with $151,000 because she stayed invested long-term. The only true loser. Larry Linger, who procrastinated in cash waiting for the perfect dip. He finished with just $47,000. This brings us to why DCA is a psychological lifesaver. A lot of people say, "I'll just wait and buy the dip." But when a real market crash actually happens, like the COVID crash in 2020 when everything plummeted 30+%, human psychology flips. Logic leaves the room and absolute panic takes over. Instead of buying the discount, most people freeze, get terrified, or worse, they panic sell at the absolute bottom. DCA protects you from yourself. Because it's automated, It forces you to buy when you are scared, turning market volatility into your best friend. So, which one is right for you? If you have a long time horizon and you can handle watching the market fluctuate, history says lump sum investing gives you the highest probability of maximizing returns. But if seeing your portfolio drop 20% would make you panic, or you're investing from your monthly paycheck, dollar cost averaging may actually be the better choice, not because it's mathematically superior, but because you're far more likely to stick with it, and consistency beats perfection. There's also a middle ground. Invest half today, then automatically invest the remaining half over the next 6 months. You capture much of the market's historical advantage while reducing the emotional stress of investing everything at once. At the end of the day, the best investment strategy isn't the one that looks best in a spreadsheet. It's the one you'll keep following through bull markets, bear markets, and everything in between. Remember, as the saying goes, the best investing strategy is simply the one you can actually stick to without panicking. What's your go-to strategy? Let me know in the comments below, hit that subscribe button, and I'll see you in the next video.